Councilmember Schneider today. Today's agenda includes two items. The first item is the September 30, 2009 investment report and fiscal agent report. The second item is the fiscal year 2009 general fund final balancing and adjustment. So I'm going to turn this over to Mr. Samario.
Thank you, Mr. Chair, members of the committee. Bob Samario, Interim Finance Director, and actually Jill Tarr, our Treasury Manager, will present the investment report for September 30.
Good afternoon, Chair Horton and Committee Member Schneider. I'm Jill Tarr, Treasury Manager, and here to present the September 30th investment report. The report also contains a September 30th fiscal agent report, since it is a quarter-end report. I'll give a very brief overview of the economy, the national economy, and then go through the activity for the quarter and look into more specifically some of the September activity. To start with, over the quarter, we saw mixed signals of economic recovery, which continued. The financial markets rallied for the seventh straight month since March 9th lows, where the Dow Jones Industrial Average fell below 6,500. Treasury yields moved lower during the quarter, where we saw investors do a flight to safety in spite of increased Treasury supply. The Treasury continued to issue debt coming onto the market to fund the stimulus and federal bailout programs. CPI for September increased a modest 0.2%, indicating that inflation is under control. And we saw national unemployment reach a record high of 9.7%. The Federal Open Market Committee also kept the Fed funds rate at a 0 to 0.25%, and again reiterated that it would continue to stay low for an extended period of time. We'll look at the investment yields over the quarter. And as you can see, on a quarterly basis, we measure ourselves against three benchmarks, being the 90-day T-bill, the 2-year Treasury note, and the LAIF rate. And the top line is the city portfolio yield, which for the first time in a long, long time fell below 3% for the quarter end. The rate was 2.919, still well above our three benchmarks. The 2-year Treasury was at 0.96%. The LAIF investment pool fell to 0.75%, and we do expect that to continue to decline over time. And the 90-day T-bill rate was at 0.11, just barely above zero. So we continued to outperform the benchmarks, but I do expect that our portfolio yield will continue to decline as we repurchase investments that have matured or been called at a lower rate, subject to just what's out there in the market right now. On page 2 of the Council Agenda Report, you'll see the investment activity for the quarter. We had purchases over the quarter of $20 million. We purchased federal agencies, a mix of Fannie Mae, Freddie Mac, and FHLB, and we're able to pick up one Federal Farm Credit Bureau piece. We continued our strategy of mixing both bullets and callables because of the pickup, and use them as a LAIF alternative, anticipating that they would get called on the first call date because the yields are so high. We had calls during the period of $6 million and maturities of $10.5 million. So we had net investment activity of $3.5 million more in purchases than we had in calls and maturities over the quarter. If we move on to attachment 1 on the right-hand side, we'll move on to the activity for September. The normal monthly report that I give. The interest income on the pooled investments for the month of September was $375,499. Interest earned on LAIF investments during the month of September was $14,219. And the total for the month of September was $389,718. On to attachment 2 of the CAR. You'll see the ending balance of the city's portfolio at the end of August was $161,336,392. We had roughly the same balance at the end of September at just over $161,157,000. The balance in the state money market account, LAIF, was $41,600,000. Certificates of deposit, that's the singles CD we hold at Montecito Bank and Trust at $2 million. We had federal agencies at just over $97 million, and a few corporate medium-term notes at $10.2 million. In addition to the regular holdings in the investment portfolio, we also have the 20-year Santa Barbara Airport promissory note at $7.3 million, and the cash at our money market account at Santa Barbara Bank and Trust at month end, fully collateralized, was $2.786 million. Again, you can see...
Question on that, Jill?
Yes.
How does that cash level compare with previous months? It seemed a little low to me.
It is a little lower. It depends on what outstanding AP issues and payroll checks we have. We put in a cushion. We have a minimum required balance, compensating balance of $2.3 million, so I try and keep it close to there, but it does depend on what's outstanding in terms of what's issued. So I try and keep it on the lower end than the higher end, but it is lower. The yield to maturity, as I mentioned before, on the portfolio at the end of September was 2.919%. And the average days to maturity on the base portfolio is 607 average days to maturity. If you factor in the 20-year airport promissory note, it's 912. And that concludes my report.
Are there questions from committee? And welcome to Ms. Falcone. Motion?
I'll move this to the consent
Is there
calendar.
a second? All those in favor say aye.
Aye.
Motion carries. Thank you, Jill. Mr. Samario, balancing.
Okay, well, thank you, Mr. Chair and members of the committee. So back on August 25th, 2009, we presented a preliminary report to City Council on the year-end results for fiscal year 2009. And at that time, we estimated that we were going to end the year in the general fund about $2.5 million short of budget. That was primarily revenues. In fact, if you recall, back in mid-year for last year, we came to council and proposed a strategy to rebalance the general fund in light of about a $6.8 million shortfall, both revenues and expenditures, primarily because of revenue declines. And we did rebalance the budget, made adjustments, but since that time, revenues continue to decline, and by end of the year, we ended up with about $2.5 million shortfall. In August, we were there to give you preliminary results. We didn't have final numbers yet. Since that time, we have had our auditors in, and they've completed their field work. We feel pretty confident now, 99.9% confident that the numbers are final. I guess they're theoretically subject to change, but we think we can come forward with the final adjustments and recommendations to address that shortfall. So we'll start with just kind of a look for the year at final revenues and expenditures. On the left-hand side, the three columns of numbers are the revenues, and then to the right of that, three columns of numbers are the expenditures. And you can see that our annual budget and revenues were about $108 million. Actual revenues for the year, a little bit under $104 million, resulting in a shortfall of about $4.3 million. And, of course, that was our biggest culprit for creating the deficit. On the expenditure side, you can see that just about every department came in under budget. The very top line, which is the non-departmental, the $700,031, represents primarily the appropriated reserve we had established as part of the adopted budget that we had, by design, left unspent. But what I wanted to point out was a couple of things. One, the overall variance, $4.3 million. We talked about this extensively. That was part of the 2009 strategy. Somewhere around November, December, departments were asked to hold back expenditures. We had targeted about $3 million, 3.5, and they actually did better than that. You could see we came in about $4.3 million under. There is one department, the police department, that actually exceeded their budgetary authority, and we're going to be talking about an adjustment to correct that. It's $222,000 over budget, and that was a result of overhiring per direction of council. So we expected that. We were tracking that all along, and we anticipated they would come in over budget. Now, if you look over to the left of that number, on the revenue side, you can see that they also had a favorable result at the end of the year in their revenues by $149,000, almost $150,000. So the adjustments we're going to recommend to council today is to increase or at least fund part of that overage from additional revenues. So the real impact is about $72,000, and we'll talk about that more in a moment. But on the bottom, you can see that the final results, revenues minus expenditures, resulted in a net deficit of almost $2.6 million. And that's the shortfall we wanted to address through our proposed adjustments. So this little table is in your agenda report, and you can see what we're recommending. We talked about these three strategies or alternatives back in August. There were three pots of money that we could have gone to. One is the City Hall Allocation Fund reserves. That fund currently has a balance of about $450,000. The money has been accumulated to replace the City Hall's telephone switch. It's of course it's located at City Hall. In talking to Jim Dewey, our facilities manager, he says that it could be replaced any time between 5 and 10 years, closer to 5 years. But if we spent a couple $100,000, it could extend the life 3 or 4 years. That $200,000 would then reduce that balance to $250,000. So they still have enough money to make necessary adjustments or corrections or improvements to extend the life of that switch beyond 5 years, closer to 10 years. In the street sweeping fund, we have approximately $450,000 as well, or I'm sorry, $300,000. They have a total of about $500,000, but we wanted to retain $200,000 in that fund just as an operating reserve because, as you know, the program is fully implemented, but the parking citations which fund that program have been sort of diminishing over the last couple of years. So we want to maintain some kind of reserve. So we're proposing that we take $200,000 of the of the four to leave a balance of $200,000 as part of the solution for the general fund deficit. And then the rest of it is just to balance it from the workers' compensation fund reserves, really the self-insurance fund, but it's primarily from the workers' compensation program. Almost $2.2 million we're recommending to address the total $2.6 million shortfall. And I just want to mention that Mr. Horton asked a question of us about the self-insurance fund and what it's looked like over the last several years and what it's looking like out in the future, and we'll address that. I have some slides for that. But I just wanted to go quickly through the technical adjustments that are going to be required and we'll be recommending to Council. In the general fund first, you can see that we're going to increase appropriations from estimated revenues, the 149. That was the overage in revenues in the police department. We are proposing to take the balance that's needed to cover the $222,000 shortfall in the police department from appropriated reserves. That's $700,000 I mentioned. We're proposing to take $72,661 from that account, which is in the non-departmental program, which is shown below. So you'll see that allocation on the first line of the non-departmental department. And the other three is to recognize the revenues, the transfers from those three funds, the City Hall Allocation Fund of $200,000, same amount for the Street Sweeping Fund, and then the balance of $2,191,000 from the Self-Insurance Fund. And then down below, it's just really recognizing the appropriations needed to fund those transfers out of those three funds, the Self-Insurance Fund, City Hall Allocation Fund, and Street Sweeping Fund. So getting back to the question of the self-insurance fund, I wanted to show you a couple of charts or graphs or tables. And first, this is, you can zoom out so we can see the details on the left. Rudy, thanks. And I apologize, I'm not going to get into too much of the numbers because I got another graph that visually depicts the same story. But this is basically a presentation of the balance sheet of our self-insurance fund starting in fiscal year 2000 all the way to 2009. So it's a 10-year history. Now, we start in 2000, you'll see that the assets are primarily cash, which makes sense. There aren't a lot of other kinds of, there aren't loans receivable, or everything else is really short-term receivables, but nothing of significance. The primary asset, if you will, is the cash that fund has. In the liability, you'll see that there are two primary liabilities, one for the workers' comp program and one for the liability program. As you know, there are two primary programs in that operation or the risk management division. One is for workplace injury and to pay for essentially claims related to injuries here on the job. And the other is more the trips and falls liabilities that the city receives claims for, and we establish liabilities for that program. And then the balance is really the reserves. It's sort of what we talk about in the general fund, the available reserves. But in this case, it's a little different because every 2 years we get a report from our actuaries, and they tell us essentially two things. What should we have in reserves, claim reserves for those two programs? And whatever they tell us that is, we actually book those as liabilities. So they actually are presented on the balance sheet as liabilities. So that theoretically, any excess we have that is shown in the reserve category in that year, 640,000, is in a sense excess reserves. We wouldn't need those theoretically to pay off all outstanding claims. So in that year, we were essentially pretty well balanced. We had a sufficient cash to cover the amounts the actuary said we should have for workers' compensation and liability based on outstanding claims and just in general what are called incurred but not reported claims. Now, we go over to the right, you can see things change pretty dramatically. First of all, you'll see that the workers' compensation liability, this is the first line on the liability category, goes up. And that's we've seen that trend go from basically $4 million all the way up to a high of $9.8 million. But after that time frame, we started, and shortly before that, we started implementing the modified work program. There were changes in state law, but basically we started to see reduced injuries on the job, and our liability that was told to us by our actuary started to diminish substantially. And you can see now that it's been cut almost in half. So it's 2009, it's back down to $4.8 million. If you look at the liability line item, you'll see that that number actually grew for a few years in 2005, 6, and 7. That's when we experienced a couple of big claims, liability claims, but those numbers are starting to diminish now. So if you can just go to the next little chart, this just sort of shows the same numbers but more linear and just in a line chart. You can see that the line on the top right are the assets, so it's primarily cash. The middle line are the accrued liabilities, both workers' compensation and the liability program, and then our reserves, and they really interplay with one another. But you could see that our accrued liabilities grew substantially over time. But our assets, obviously grew over time because we needed to fund those. But we had a deficit for a while, this chart. Let me make sure I got this right. I don't think it's right. No. What I wanted to show was that the reserves, and maybe we can go back. Let's go back to the previous table. And I apologize for that. If you look at the reserves category, the bottom third, you could see that the numbers go from a positive in 2000 to a negative. At one point, in fact, the sort of the peak of that was in 2003. We had a deficit, if you will, of almost $6.8 million, which meant that the actuaries told us we should have $10.7 million in accrued liabilities booked or reserves, but we only had $3.9 million. So we were short by $6.8 million. So we were underfunded in our accrued liabilities by, obviously a huge amount. But you can see that trend has since turned. It's gotten better. It became positive for the first time in 2005. And then now you could see that in 2009, we've gone to where we're just almost the complete opposite. We are $6.1 million to the good. So not only are we funding our accrued liabilities of $6 million, but we have monies in excess of that by $6 million. And you can see that's represented in the cash line item of $12 million. So essentially what that means is that we've accumulated more reserves than are technically required, and it's been accumulated from premiums that have been paid by the various funds and departments over time, primarily in the last several years. And that's why over the last couple of years we've recommended that in helping to balance the general fund, that we use some of those reserves, at least for the portion attributable to the general fund, because some of that relates to enterprise fund, that we use some of those because we've essentially been accumulating more than we need. And even with those adjustments over the last couple of years, we've still been able to grow those reserves. And that's why today we think that it's reasonable and appropriate to say let's use a portion of those reserves, $2.1 million, and use it to fund the large portion of the general fund deficit for 2009. It still leaves about $1 million in that fund that's attributable to the general fund, and there's some portion, of course, closer to $2 million that's attributable to the enterprise fund, but it still leaves $1 million for the general fund portion that it would be available in future years if necessary. But we think it's a reasonable use of those funds that's been accumulated from those general fund departments. So with that, I'd be happy to answer any questions. I hope that was responsive to your question, Mr. Horton.
Yes. I'm glad you put the table up there because it makes it pretty clear. I guess my kind of follow-up question was, if we were to look out, say, 5 years, what would that look like? Or can you take a stab at that?
Sure. I think that's a good question. I would say that the workers' compensation program has pretty well stabled or stagnated in terms of what its volatility. We expect, at least in talking to risk management folks, that maybe we might see some increase over the next few years, but nothing of significance. It's pretty much bottomed out. The modified program and change of state law, those have had their impacts. We don't expect much decline in those liabilities. You could only go so far in a sense. So we expect that to be pretty stable. The liability program, we're hoping that actually goes down some. Again, we're still kind of coming off some big claims. You can see the trend is downward, so we're hoping that kind of is at least level, if not going down.
Ms. McQueen.
Thank you, Mr. Chair. In the reserves, and I realize that there's a general fund allocation from the departments in the general fund, and then there's the others from the enterprise funds, and everybody puts in, pursuant to a formula, the amount their department needs to have covered for their individual employees. My question is not about the enterprise fund piece of it. It's about the general fund piece of it. And as a whole, the cash has been accumulating, which means we're doing lots and lots of things right. But my question is whether or not any consideration has been given to reformulating the general fund department contribution. I already said formula, so I won't say it twice. But do you see where I'm going? That the various departments in the general fund are giving X amount each pursuant to a formula. In that money seems to be accruing. And I'm not adding the enterprise funds, but I guess this concept or this question would go across the board to even the enterprise funds. Is there any notion of stepping back a bit and looking at the formula of contribution so that we're not accumulating more than we need and therefore then having to take back and give back to the general fund, which they should have kept or could have kept part in the beginning? Any thoughts on that?
Sure. I mean, that's a good question. Again, every 2 years we get a report from our actuaries, and they tell us what our accrued liability should be, how much we should have in reserves, and they recommend to us essentially what should be next year's premium, is a funding strategy or an amount.
Is that as a city as a whole?
It's for by fund and even by department, so it indicates.
So they do break it down.
They calculate it by department in terms of how much premium should be charged. So, and typically they're more conservative in that they recommend that the premiums be higher than we think they typically are. There should be based on the past history, and in fact, we sometimes in the past several years have not implemented their full recommendations. We've lowered what we think should be, based on their report, we've lowered it so we don't accumulate these reserves because we don't want to accumulate reserves.
Well, that's my point. I mean,
Right.
Why accumulate the reserves beyond and above
Right.
what we're actually really,
Right.
as a
And-
trend, paying in claims, be they workers' comp or lawsuits or settlements
Right.
or whatever.
And
That's
I would
my
just
point.
add-
Why-
And I would just add to that, that's why in the last several years we have, in a sense, rebated to the general fund and enterprise funds a portion of those reserves because they're in excess of what's needed. I think that's just that the turnaround, particularly in the workers' comp program, was so quick that it's sort of, as much as we try to give it back, it still continues to.
I guess that's a good way of putting it, and I think I'd like to put that out there, and that what we are doing here with this particular adjustment is not so much a borrowing from Peter to pay Paul. It is, oh, hi, Paul. No. Borrowing from Peter to pay Paul, but it is more of a rebate back to the general fund departments of monies that they didn't use but contribute to the fund pursuant to this formula, and so that we're giving it back to them for their budgetary
That
use.
is correct.
And there is some flexibility with the formula. I heard you say that you have a certain amount of autonomy and tailoring it to what we need as opposed to the actuaries, which do a large statewide picture by city thing.
That's correct.
Okay. Thank you.
Further questions? Ms. Schneider.
Thank you. I mean, most of this was brought up with the full council in August, so this is just tying the bow on it and bringing it to council. But I do want to express appreciation with all the departments looking at that they were actually how much they were able to go under their budget during the course of the year in order to meet as much as the gap as possible, and completely understandable that except for the police department because we told you to, in terms of overhiring for the staffing that was there. So that seems completely appropriate to me. But otherwise, I think this is just, finalizing what we've done a few months ago. And just to really make sure it's clear for anyone listening, the term reserves is bantied about all over the place, and there's different types of reserves. And I know there's been a lot of talk about the operational reserves, of which not one penny is being used to balance the shortfall from last year for either the operational piece nor the emergency disaster reserve. So just to be crystal clear on that, I think is important.
Thank you. And is there a motion?
With that, I'll move this to the council.
Is there a second?
Second.
All those in favor say aye.
Aye.
Motion carries. Mr. Samario, further action for the committee?
No, that's it. Thank you very much.
Meeting adjourned.